Market crashes are periods of intense volatility and fear for most investors. Retail traders, those with smaller accounts and less experience, typically react with panic. The sudden and sharp decline in asset values triggers an emotional response. This often leads to hasty decisions driven by fear rather than logic. During these turbulent times, the prevailing sentiment among retail participants is one of desperation. They see their portfolios shrinking rapidly. The instinct is often to stop the bleeding immediately. This results in widespread selling activity. While retail traders are selling in fear, a different group operates with a contrasting mindset. This group is often referred to as smart money. They view market crashes not as a disaster, but as a significant opportunity. Their perspective is long-term and strategic. Smart money participants are actively buying assets during these periods of peak fear. They are accumulating positions while others are liquidating theirs. This counterintuitive behavior is a hallmark of their approach. They understand that market downturns are temporary phases. By buying when prices are heavily discounted, smart money positions itself for substantial gains. As the market eventually recovers, the assets acquired at low points appreciate significantly. This allows them to achieve remarkable profits during the subsequent upturn. These profits are often far greater than those made during stable market conditions. This video will reveal the specific strategies and tactics employed by smart money during market crashes. We will explore how they identify opportunities and execute trades while others are paralyzed by fear. Learning these methods can help you shift your perspective. You can learn to profit from market crashes instead of being a victim of them. Welcome to Online Trading Hub. This channel is dedicated to demystifying the financial markets. Our goal is to decode the strategies used by top traders and institutions. We aim to provide actionable insights for serious traders. We understand the frustration many retail traders face. It's common to feel like you're always a step behind. Many experience the pain of buying assets near their peak. They then watch them fall, only to sell near the bottom. This cycle can be incredibly damaging to a trading account and confidence. Our focus today is specifically on breaking down the tactics smart money uses during market crashes. These are the periods where the biggest wealth transfers occur. Understanding their actions is crucial for navigating volatile markets successfully. We want to show you how they operate. By understanding their methods, you can begin to anticipate their moves. You can learn to identify the signs they look for. This knowledge empowers you to make more informed decisions. You can stop reacting emotionally to market swings. Our aim is to empower you to use these smart money tactics yourself. While you may not have the same capital or resources, you can adopt their mindset and analytical approach. This can fundamentally change how you interact with the market. It can turn fear into opportunity. So, who exactly constitutes smart money? This term doesn't refer to individuals who are simply lucky or inherently smarter. It primarily refers to institutional players within the financial markets. These entities operate on a massive scale. This group includes large hedge funds. These funds manage billions in assets and employ sophisticated trading strategies. Big banks are also part of this category. Their trading desks execute enormous volumes of trades daily. Asset management firms handling vast portfolios for clients are included as well. Beyond these large institutions, smart money also encompasses seasoned professional traders. These individuals possess significant capital. More importantly, they have years of experience and deep market insight. They understand market structure and participant psychology. What sets smart money apart is not just capital size. They possess superior trading tools and technology. They have access to better data and research. Crucially, they operate with a high degree of discipline and emotional control. They stick to their plans regardless of market noise. While you might not be an institution, you can learn to adopt their mindset and analytical framework. This is the key takeaway for retail traders. It's about thinking strategically and long-term. It's about removing emotion from your trading decisions. By learning to analyze the market through the lens of smart money, you can identify high-probability setups. It is absolutely possible to profit from market chaos. You can do this by understanding and emulating how these large players operate. Smart money does not fear market crashes. In fact, they anticipate and prepare for them. They view downturns as predictable phases within the market cycle. Their approach is proactive, not reactive. Their strategy is built well in advance of major market moves. They aren't making decisions on the fly during a panic. Their plans are laid out months, sometimes years, ahead of time. This preparation is key to their success. Preparation involves continuous monitoring of key price levels. They identify significant support and resistance zones long before the market reaches them. These levels are often where large amounts of capital have previously changed hands. They also track volume imbalances meticulously. They look for divergences between price movement and trading volume. They identify liquidity zones, areas where large clusters of stop-loss orders or pending orders are likely to reside. These zones represent potential fuel for market moves. Crucially, smart money accumulates cash or maintains flexible capital positions, while others are fully invested or overleveraged. They reduce exposure as markets become frothy. This gives them the dry powder needed to act decisively when prices fall. They are not caught off guard with illiquid positions. They wait patiently for the optimal price point to enter the market. They do not rush in on the first dip. They understand that crashes often overshoot to the downside. They wait for signs of true capitulation. Smart money strategically buys into market fear. When retail traders are most panicked and selling indiscriminately, smart money sees value. They are buying assets at prices they determined were attractive long ago. This requires immense discipline. A market crash is not a random event to them. It is seen as a predictable opportunity. It's a chance to acquire quality assets at a significant discount. This perspective is fundamentally different from that of most retail participants. The market crash in March 2020, triggered by the COVID-19 pandemic, serves as a perfect real-world example. The speed and severity of the decline were unprecedented for many. This event clearly illustrated the difference between retail and smart money behavior. As news of the pandemic spread and lockdowns began, retail traders engaged in widespread panic selling. Fear dominated the market narrative. Many sold their investments at significant losses, unable to stomach the volatility. The focus was solely on preserving remaining capital. During this exact period of peak fear and selling pressure, smart money was actively buying. While headlines screamed doom, institutions were quietly accumulating positions. They saw the crash as a temporary disruption, not a permanent collapse. They identified areas where liquidity was spiking. As retail stop losses were triggered on the way down, it created pools of sell orders. Smart money used this selling pressure as an opportunity to buy in size without significantly moving the market against them initially. They often waited for what is sometimes called the capitulation wick. This refers to a sharp, rapid drop in price that quickly reverses. It represents the final washout of sellers before buyers step in aggressively. Identifying this point is key. During the 2020 crash, smart money was buying blue-chip stocks, established companies with strong fundamentals. They were accumulating positions in broad market ETFs like the S&P 500. Even assets like Bitcoin, which saw a dramatic drop, were bought up by savvy investors. The returns achieved by those who bought during the March 2020 lows were significant. Many assets doubled or even tripled in value in the months that followed. This rapid recovery rewarded those who had the conviction and capital to buy the dip. This success was a direct result of trading the fear. It came from having the preparation and discipline to buy when others were selling. It was about recognizing the opportunity to acquire assets at a substantial discount to their intrinsic value. Smart money employs several specific tactics during market downturns. Understanding these can help you recognize their footprint. It can also help you avoid being on the wrong side of their trades. One key tactic is known as trap and reverse. Smart money may initially push prices lower, triggering retail stop losses placed below perceived support levels. This creates a cascade of selling orders. Once these stop losses are triggered, providing ample liquidity, smart money then aggressively buys back positions. They acquire assets at the lower prices created by the stop-loss cascade. What looked like a clear breakdown to retail traders was actually a calculated trap. The price then reverses sharply upwards, leaving late sellers behind. Another tactic is scaling into weakness. Instead of trying to perfectly time the absolute bottom, smart money buys gradually as prices fall. They deploy capital in stages. This approach manages risk effectively. They don't put all their capital to work at once. If the market continues to fall, they have more capital available to buy at even lower prices. This lowers their average entry price. A core principle behind many of their actions is liquidity hunting. Smart money actively seeks out areas where large amounts of liquidity are concentrated. These are typically areas where retail traders place their stop losses or limit orders. They understand that these liquidity zones act as magnets for price. By targeting these areas, they can execute large orders with minimal market impact. They use the forced selling from triggered stops as their entry points. Understanding these tactics is crucial for retail traders. It helps you stop being the bait, the liquidity that smart money hunts. Instead, you can learn to identify these potential traps and turn them into opportunities. You can start thinking like the hunter. While you may not have billions in capital, you absolutely can think and trade like smart money. It's about adopting their principles and discipline. Size is less important than strategy and mindset. The first step is to always use a structured trading plan. Smart money operates with detailed plans for various market scenarios. Your plan should define your entry criteria, exit strategy, and risk management rules before you enter a trade. Do not make decisions based on emotion during market hours. Analyze macro trends instead of getting lost in short-term noise. Smart money focuses on the big picture: economic cycles, fundamental value, and long-term market structure. Don't obsess over minute-by-minute price fluctuations. Understand the broader context. Implement professional-level risk management. This is non-negotiable. Never risk more than a small percentage of your capital on any single trade. Avoid over-leveraging your positions, especially during volatile times. Smart money prioritizes capital preservation. Study volume and liquidity alongside price action. Don't just look at charts. Understand where volume is concentrated. Look for signs of institutional accumulation or distribution. Identify potential liquidity pools where stops might be clustered. This adds depth to your analysis. Crucially, control your emotions. Discipline is perhaps the single biggest edge smart money has over retail traders. Fear and greed are the enemies of profitable trading. Stick to your plan even when it's difficult. Learn to remain calm during market turmoil. Market crashes are not just periods of destruction. They are periods of immense opportunity for those who are prepared. By adopting the mindset and tactics of smart money, you can position yourself to capitalize on these opportunities. Preparation is the key differentiator. In conclusion, smart money views market crashes fundamentally differently than retail traders. They prepare for them, anticipate them, and strategically profit from them. While retail traders panic and sell, smart money buys. You now have insight into their perspective and some of their key tactics. You can begin to apply this knowledge to your own trading. Start building your trading plan today. Focus on preparation, discipline, and understanding market structure. If you found this information valuable, please show your support. Liking this video helps us reach more traders who can benefit from these insights. Sharing it with your trading community is also greatly appreciated. Don't miss out on future strategies and market analysis. Subscribe to the Online Trading Hub channel. Hit the notification bell so you're alerted when we release new content. We are constantly working to bring you the best trading education. We also want to hear from you. What are your experiences during market crashes? Do you have questions about these smart money tactics? Leave a comment below and join the conversation. Your engagement helps the whole community learn. At Online Trading Hub, our mission is to help you trade smarter. By understanding the strategies of the market's most successful participants, you can improve your own results. Thank you for watching. We'll see you in the next video.